Hello, everyone. Hope you're doing well. This is the recorded lecture for Debt and Equity Capital. And just like before, we start off with the stages of the audit, and we're basically trying to apply these stages to each transaction cycle we encounter. And so we're obtaining the understanding, assessing risks, performing the audit procedures. And so if we look at the learning objectives here, I structured these a little bit differently, partly because we both basically have two different transaction cycles here. We have a debt transaction cycle and an equity. You might call them both the financing transaction cycle, if you will, but there's two different set of significant accounts, debt and equity, and the chapter is laid out in that way to where they basically mirror each other in terms of going through our standard set of learning objectives. Um, so, again, I like to use the audit risk model to try and frame the learning objectives. And so, thinking about first, kind of what's the nature of the transaction cycle, I kind of slightly changed this to add a box here for the first learning objective. Oops, wrong direction. And so, again, we're going to start with debt, and then we'll work our way through equity. So, long-term debt, right, obviously, you've had exposure to this. This is financing that can take pretty significant amount of time. Often it's 20 years or more, or at least 10. But these would be things like mortgages or bonds, long-term note payable. And a lot of times what you see is the attempt by the firms to match the term of the financing with kind of the useful life of what you're intending to acquire with the financing. So think about a mortgage. Mortgages can be 10 or I guess you can have 10, but a lot of times they'll be 15, 20, 30-year mortgages. And so the reason is because we expect the houses to last for a long time. Or if you had a building as a company, you'd expect to be able to use that building for a long period of time, right? So you want to match the cost of the building, which financing is a cost of the building, even though we don't necessarily record it under a building expense. But firms try and match the term. And so, and there usually is some formal documents, whether it's a mortgage or um, uh, a debt covenant, or excuse me, a debt contract. Uh, and we'll talk about these restrictive covenants here in a little bit, but these are essentially things that help make sure that the company or individuals that are loaning the money are going to have some protections that they'll be paid back, right? So, um, obviously, this financing cycle is all about acquiring these funds. Um, and the cost of acquiring funds is paying interest or dividends if we're talking about equity. Um, and so one of the big things, since these are usually pretty large transactions, you don't have a lot of them, and so making sure they're properly authorized tends to be one of the big issues, right? Are these valid transactions? A lot of times the board has to approve, uh, large issuances of debt. And so that's one of the big areas of concern here. When we think about the audit objectives, how do the assertions map into debt? And so substantiating the existence of debt. Usually, if you think about the incentives of managers, it's usually not to try and add debt to the balance sheet that doesn't exist, right? This is usually not a primary concern. Usually, if most of the time managers are trying to make the firm look better, so they want liabilities to be lower, which means they want to basically omit some recorded debt. So really, that's a completeness issue. So really, completeness becomes one of our primary issues or primary concerns. And the other one would be kind of presentation and disclosure. Uh, there are some important disclosures around the classification, right? Short-term versus long-term debt. And then the other one I would say is kind of the accuracy, kind of and valuation, which are tied together. So like amortization is a big one, and actually I'm kind of previewing what one of our slides is going to say a little bit later, but those tend to be the ones that we're focused on the most. Uh, but kind of moving through the audit risk model, looking at the understanding the client and the environment in order to assess inherent risk. Okay, so the inherent risk here, understatement of debt, uh, disclosure of debt, and determination that they've actually met all of their debt agreement. Okay, so those are some of the inherent risks, and obviously we're going to pair that with the understanding the client environment, understanding the industry, understanding what growth stage the firm is in, understanding what markets that they're trying to acquire debt from. Is it New York Stock Exchange, NASDAQ, over the counter, right? All those different things kind of help go into this inherent risk. When we think about internal controls over interest-bearing debt, then again, the biggest one is around authorization. It has the board approved, and we're talking here for substantial amounts of debt. Now, obviously, you can have smaller amounts of debt, and it would depend on the company's charter as to what's the threshold that would require authorization from the board. But you could conceivably have some, 2 and 3 year debt that would still technically be long term because it's not within a year. You still could conceivably have that debt, and it would not require authorization by the board. But typically, when we talk about these long-term debts, we're talking about pretty substantial terms on these debts, and that would require authorization in most cases. Trustee can help. We're talking about especially things like bonds payable. Help manage that process in terms of knowing who owns, especially if the bonds can be sold secondhand, in the sense of you might have an initial offering of the debt, but then they're traded on an exchange. If that's the case, then you need a trustee to keep track of who actually is your owner at a given point in time, especially if you're making interest payments to them on a regular basis. So that's going to help control the process. Also, the fact that you already have a cash disbursement process with your client, or your client does, and so paying interest payments, whether on bonds or notes payable, is going to have to go through that same cash disbursement process and the same controls in terms of authorizing, being separate from recording, being separate from custody, right? So you're going to have a set of controls there that are going to help. And so then some of the big questions are related to these. Is new debt authorized by the appropriate level of managers or board? Is the independent trustee used for all bond issues? And does a company, do we have an individual that's monitoring compliance with debt provisions, especially the covenants, right? So those are the controls that we would be focused on. Again, once we feel comfortable about those cash disbursement controls, then these are kind of the additional things we would look at related to debt. And then thinking about the assessing the risk of material misstatement. And again, kind of the big areas of misstatement here are related to debt covenants. And so those are covenants that either require certain performance measures to meet a minimum or a maximum threshold. So for example, you have to have a minimum amount of working capital, or you have to have a minimum amount of cash available to pay interest payments, or you have a minimum amount, a maximum amount of debt to equity ratio, like you're not allowed to have above a certain amount, or you're not allowed to give out more dividends relative to the amount of income you have, right? There might be a maximum amount of dividends you can pay or your client can pay. Again, those are meant to protect the debt holder. So they can either require certain things be met, or they can, insurance would be another one, or they can disallow certain actions, right? So you can't take on debt that's more senior to the debt that's already there, right? Um, and so, or you can't take on debt that has, you know, a certain term to it. Like you can't take on any debt that's greater than 5 years term or whatever. And so, covenants are meant to protect those debt holders. And if the firm violates, then a couple things get kicked in. One is that the debt becomes payable on demand, and so you have to reclassify all of that long-term debt to current debt, right? Um, and that's going to have a big impact because there's a lot of ratios out there that are concerned about, like the current ratio or quick ratio, where you're basically using current debt as the denominator there. So if you're all of a sudden throwing a bunch of debt in there, then now some of those ratios are going to look pretty bad. And it raises the possibility of a going concern. So do you have the funds, or does your client have the funds to pay all of that debt in the next year, right? And if they don't, then you have to issue a going concern. Now what tends to happen is you have a violation and then there's a renegotiation of the debt. And so maybe then the debt holder agrees to have for example, a higher interest rate. You violated the debt, so you have to have a higher interest rate. Now you may have to spread that out over more years possibly to make the payments manageable for the firm, but there's some renegotiation is going to happen, and it's usually going to be in the favor of the debt holder because now all of a sudden you're showing that the client is showing that they're a riskier investment. Also, misclassification of debt can happen in general in terms of not putting the correct portion in current versus long term. This is a fairly easy thing to test for, though, once you know the structure of the debt contracts. You can have an inaccurate amortization of interest and principal. Again, you can have software, though, that tests that relatively easily to see if we have an issue with amortization. And you can just have a general non-recognition of debt on the balance sheet. So this is kind of what Enron did, right? They basically were trying to get a lot of these off-balance sheet set up where they would have these variable interest entities where they had some control over taking on debt that they would then exchange for some asset of this other entity, but the entity was there just to take the debt off the balance sheet. But obviously the FASB has made steps to try and reduce the possibility that can happen, but obviously that's still a possibility. Okay, so I think I'll pause here and then I'll start up another video with the other audit procedures for the rest of debt.